There are only two things that are for certain in this life: death and taxes. Likely, many of us are going to be paying taxes in 2025. So today on our show, we're going to be talking about what is and what is not taxed. Let's go. Welcome into Mindset. I'm Brad Barrett, your favorite wealth manager. And today on our show, as always, we're going to be talking about pertinent and topical things. And I can't think of anything more pertinent topical than tax season. What do you think?
Tax season. I'm excited.
I love tax season, said no one ever. But we're going to make it fun for you today because it's also, look, knowledge is power. I don't know about you, but like you, I'm a taxpayer. So in about a month or so, I'm going to start gathering everything. And then I got to file in April and so on and so forth.
Fingers crossed, get a big check back. I don't know.
I think everyone goes into this season with a little anxiety, a little fear, a little angst, I guess. But also maybe for some of us, it's a little bit of like, oh, I'm going to get this check back.
Show me the money!
And we're going to talk about those kind of things because, as you know, in our show and with me, I like to talk about the planning aspect behind it. And at the opening of the show, we talked about one of the more famous quotes around taxes, which are, death and taxes, the Ben Franklin quote. I've always used that one because, one of my sayings have always been on our radio programs and on our show here is the one certain thing I do know is there will be uncertainty. So the fact of the matter is that we can bring some certainty to our life, which is death and taxes. It is what it is.
Well, Brad, I'm a huge Ben Franklin fan.
I do know that.
Exactly.
Bifocals, come on now.
Hey.
He retired at 41. He had accumulated so much money that he retired from his print business, but he only had 2 years of education.
I did not know that.
Yeah.
That's actually pretty impressive.
Fascinating guy. You've heard of the Poor Richard's Almanac?
I have.
Amazing quotes. Wealth is not his that has it, but his that enjoys it.
Ooh, deep.
Love that.
That was Ben Franklin?
Ben Franklin.
Okay, I like that.
Another one, blessed is he who expects nothing, for he shall never be disappointed.
Ah.
So taxes, I figure, sometimes I just expect nothing. And then when I get that big check, I'm excited. Or if I don't, I'm not disappointed.
Death and taxes, Ben Franklin for you. And for those of you thinking at all and clicking this show and in the environment that we're in with our new presidency and a lot of what's going on in the news, yes, President Trump was talking about some things around getting rid of the income tax and going back to tariffs. And I actually find that pretty interesting in the U.S. history because I've talked about this before, and I won't go into detail on it today, but we actually talked about tariffs not too long ago. We'll put a link here on the show. It's a good background to what's been discussed right now with our president and talking about tariffs in these countries. And many of you are probably thinking that because you're watching the news. But income taxes are really important because, yes, we all have to pay them. And it's kind of that fun notion of everyone's seen that meme, right? You've seen that where it's like, hey, government, how much do I know? How much do I owe? And they're like, well, you have to guess that. Okay, great. So you have a number. Yes. Well, do you know the number? No, you have to guess it. And then what if I don't get it wrong? Well, you go to jail.
I would like you to crunch those numbers again.
It's programmed. There's no such thing
Just
as
crunch them. Just crunch them, please.
crunch.
Did it help?
I'm guessing every year. Like, I'll be honest.
Every year.
It's like fingers crossed.
Yeah.
Am I going to have to pay or am I going to get money back?
Now, on our show, and as my role as an advisor, we talk about with our clients what types of assets are being taxed and what types of assets are not being taxed. And then the ones that are taxed, how are they taxed? So for those of you kind of clicking on this link talking about just ordinary taxes, I want to say loud and clear as well, I'm not a tax advisor. I'm a financial advisor. Now, I say that because why would a financial advisor be talking about taxes? I'll tell you why. Because it is probably one of the most important things I can do to know our code and to be able to speak dangerously about taxes without actually filing your 1040. Because we all know it's not what you make, it's what you keep. As you relate that to your financial planning, your investment planning, ultimately your tax planning, your estate planning, your life insurance planning, I can go on and on here, you can see why taxes are probably one of the most important things we can go through. And let me stop by saying there is two types of taxes, two main ones. Let's not get crazy here. Two main ones. There's ordinary income and capital gains tax. Now there's others and different variations of those, but those are the two that I want to speak to you today about.
Now, can you clarify capital gains? Because for me, I guess when I always think about the two taxes, I think income and then I think like bonuses.
Yeah.
Is that when I get a bonus at work?
Still ordinary income.
That's ordinary income.
Yep. Bonuses, your salary, your pay, your income from your own job or whatever, that's all ordinary income hitting the tax brackets. Capital gains, basically we know that as investment tax. Like I bought something for $100,000 and that $100,000 something that I bought is now worth $150,000. I'm gonna be taxed on the gains of $50,000. So that's capital gains. Jared, I'm gonna lean it to you. What do you wanna talk about first? Income streams or accounts?
I would like to talk about income.
Ooh, you want to talk about income? Well, let's ride.
Money, money. I like it when it's coming in.
All
so
right, let's
how
talk
much
about
do I
what's
get to
coming in.
keep?
Not what we have, but what we're coming in. Okay,
Yeah.
3 things I broke down are your actual income, okay, pensions, this is ultimately when you retire potentially, and Social Security. The first one's pretty simple. Look, if you're making income, you're gonna pay taxes up to a certain level, all right? Now, whether you're a W-2'd employee listening here and watching here, or you're a self-employed, 1099, what have you, yes, there's some different things going on in terms of how you file your taxes, but you're gonna be paying ordinary income taxes. That's pretty simple. Pensions and Social Security. So whether your pension, let's talk about pension first. Whether a pension you might have comes from a private company or maybe even a government pension, the pension payments that you receive basically follow the same rules, and they're also fully taxable at ordinary income rates when you receive them. This is assuming, by the way, that you have no after-tax contributions to those pensions. Pensions are pretty simple for that point. I mean, there's not a whole lot of craziness to them. They're just ordinary income in retirement, and again, whether that comes from a private sector job or a governmental sector.
Are they taxed like if a teacher has a pension or a firefighter has a pension? Is that the same tax across
Yes,
the board?
whether it's again from government, municipality in that regard, or a private sector job, you know, it's going to be ordinary income. The Social Security benefits are interesting, and you know, this is a whole subjective matter when it comes to how these are taxed. But basically, what I want to share is that the benefits you receive, up to 85% of your Social Security can be taxed. Now, let's describe that. You can Google this. It's pretty simple to look at the rules on this one. But if you make over a certain amount per year in other areas, whether it's I have a lot of clients who are retired and they're working a part-time job, like as a marshal on a golf course. That might make 20, 25 grand a year, something like that. That'll typically hit the limit where now, if you're receiving Social Security at the same time, up to 85% of the Social Security benefit is being taxed because of your other income. This also can include distributions from accounts, pensions, things like that. This is where the nuances come in when it comes to a CPA to kind of calculate all that. But I think for those of you who are receiving Social Security, or for those of you who will be, let's just say, understanding how Social Security tax is pretty important. Now, I want to switch over to assets. So as we bring in assets here, I think this will be good for us to talk about a few of the main ones, and I'm going to start out with the mother lode here. Fun fact for you, Jared. Do you know the number one asset that I see in my client base, and I think pretty much studied?
I would guess IRAs.
IRAs and 401ks. Because it's probably likely for over 30 years, the one asset that is continually on a disciplined basis and a consistent basis for a long time period, the one asset that is actually contributed to.
You typically budget specifically for that.
You do. You typically budget for that, and it's the largest asset. So I want to start here with that because I want to make this really simple for you all. If you're investing in an IRA or a 401k, traditionally, those are what we consider tax deferred. Remember, we're talking about taxes today. So, very simple example. If I make $10,000 a year and I put in $1,000 that year into my IRA or my 401k, or again, my SEP IRA or simple IRA or whatever like that, traditionally, if I made $10,000 that year, I put in $1,000 into a tax deductible, tax deferred account, I'd be paying taxes on $9,000. Again, very simple. Catch my drift here? Now, later, when you retire, that account will be taxable. So if I get a tax deferral today, Uncle Sam's gonna wanna tax me later. Those same accounts also have Roth features, all right? Roth is the inverse of that. Same example, I make $10,000 a year, I put $1,000 into my Roth IRA or Roth 401k, I'm still taxed on the $10,000 that I made that year, but later when I retire, as long as two rules apply, I'm over 59 and a half, that's a big number, that's called early retirement age deadline, basically 59 and a half, and you've had that Roth IRA or Roth 401k for over 5 years. Again, there's some stipulations there, talk to your CPA about it or your advisor, but those matter. So, traditional 401k IRA, how they are taxed tax deductible going in, again, talk to your CPA about that, and they're taxable coming out, and they're taxable at ordinary income rates. Even though they're an investment inside of there, this is the confusion people have, Even though it's an investment, it's an asset, the way it's taxed is it's ordinary income when it comes out. There's no questions, ifs, ands, or buts about it. Simple as that.
Federal or California law?
Both in that regard.
Okay.
Yeah, and they work kind of inversely. That's a good point. I mean, the tax we're talking about today, there is, like in California, which is where we are, right? You have a capital gains in California as well. So I kind of was loosely talking about it federally and statewide as well. So for those of you who are thinking, well, are you talking federal or state?
Yeah.
That's a good point.
Yeah. And all these we're talking about were kind of federal focused?
Yeah, for the most part, because that's typically the largest one. I mean, look, we happen to live in one of the highest state taxes other than New York and maybe Hawaii, so fun for us.
Yay.
For those of you watching around the country, you likely have a lower tax rate. There's 12 or 13 of the states that have no state tax either. So that's why I generally talk about federally, because that's by and large usually what we're going through. But again, look through the rules and again, talk to your CPA about this. Moving along to assets and the types of assets you may own or are looking at and how they are taxed. Life insurance, pretty simple. Look, this is definitely an art, not a science. We do this for our clients. Long and short, if you have a life insurance policy and God forbid something happens to you and it pays out, it does come tax-free. That's like one of the biggest benefits of life insurance. It's also one of the reasons as a financial advisor, I tell my clients that the two best assets that you can pass along to your heirs is life insurance and real estate.
But life insurance, you don't look at it as like, well, obviously you'll personally never benefit. This is more of like an investment in your loved ones.
100%.
Okay.
And that's a tricky one for people, because I've shown it to people and I say, look, the IRR, the internal rate of return on a life insurance policy, depending on when God calls you back up, could possibly be your best investment, but you won't be receiving it. Your heirs will. So keeping on that train, I want to talk about annuities. Annuities are kind of an enigma, all right? It's an asset, but it falls under insurance carriers and contracts. And again, annuities can be structured in different ways. You can have a growth annuity, an income annuity, things like that. So I'm going to try to keep this as high level as I can without getting into the weeds on this. And you might have some questions on this one.
Oh, I do. Because let me full on admit.
Sure.
This might be embarrassing. I don't know.
No.
But when I hear annuity, I'm like, oh yeah, I've heard that. If you ask me like, hey, what's an annuity?
Yeah.
No clue. So, I mean, I don't know. Is that an account? Do I invest? Is that something that's like,
good? That's a great question.
No
so
idea what
let me break this down for you. An annuity is a periodic payment. That's the original word. If you look it up in the Oxford Dictionary, you look up an annuitization or annuity, it's a periodic payment. A pension is a form of an annuity. It's a periodic payment. What I want to share is this. If you buy an annuity, very simply stated, if you buy an annuity, let's say you put $100,000 in this annuity and then you wait 10 years or whatever it may be, and that annuity is now worth $150,000, you would technically classify that as an investment. Now, mind you, you can own an annuity inside of an IRA. So think of it like a shell. Okay? I have an IRA and I bought an annuity, and now that annuity is in an IRA. You can do that. I have a lot of clients who have that. You can also own an annuity as what we call non-taxable, meaning you just bought it with your savings account. Okay? What I'm going to share to you, the way this is taxed, is you would think in a non-taxable environment, for those who understand non-taxable versus taxable, in a non-taxable environment, that would be considered an investment, which would fall under the capital gains rules. This is one asset that does not, okay? Even if you own an annuity in a non-taxable account, meaning not an IRA, not a 401k or anything like that, all right? In my example, if you bought it for $100 and it's now worth $150, no matter what, no matter how long you've owned it for, it comes out taxable at ordinary income rates, not capital gains rates. All right, now to the fun stuff. I want to talk about assets. I mentioned that statement earlier about kind of what our largest liquid asset is for most Americans across the board, and my experience has been over 20 years. What do you think the largest asset is most Americans own or will own in their future or would like to own?
First and foremost, house.
House, bingo, right away. All right. On the taxability side, again, talk with your CPA about this, but I want to make it real simple. You buy a house for $500,000. If you live in that house, it's your primary residence, 2 out of the last 5 years, you will likely pay no income taxes on it if you are married. Here's what I get. Each of us get it currently, in this current law, each of us get $250,000 what's called exemption. And if you're married, that $250,000 is multiplied times 2, so $500,000. So if you bought something for $500,000, you have a $500,000 exemption, you'll pay no capital gains taxes on that. Again, that's a very hypothetical, simple example, talk with CPA, just giving you high level here. With me on that? All right. Let's say you just had a killer investment in this house. You bought it for $500,000, it's worth 1.5. Same example applies. $500,000 purchase price, that's your cost basis, what you bought it for. Okay, no taxes owed between 0 and that. The $500,000 exemption's taken, right? But you still have another $500,000 that's coming as a gain. If you sell that property for 1.5, you pay off your note, you're going to be left, again, round numbers, not including everything, round numbers $1 million, but you're only going to pay taxes on $500,000 of that.
That's
Capital gains.
That's when you sell, not every year.
That's when you sell. Great. It's tax deferred. All right, so we've talked about income streams, pensions, social securities, current income. We've talked about assets, the main ones being 401ks, IRAs, both traditional and Roth. We talked about products like annuities, life insurance. We talked about a big one as it comes to your house. I want to end on my favorite, if that's cool with you.
What's your favorite?
Stocks and bonds, baby. I live in that world.
Makes sense.
Makes sense, right, for me. Yeah.
Never show any sign of weakness. Always go for the throat. Buy low, sell high. Fear, that's the other guy's problem.
As an investor, I think these are important. These are categorized as assets. So look, if you own stocks or bonds in an IRA or a 401k, back to what we said a couple minutes ago, those follow those rules. So the reason why we talk about assets and accounts are kind of interchangeable words, but they're also not. Because you might own an asset like a stock in an IRA, the taxation of that in the future falls to the account rules, not the asset rule. So if I own XYZ stock, but I put it in my IRA, go back a couple minutes on this, rewind, and go back to what I said about how taxation is done on IRAs or Roth. Catch my drift? Now, if you own that asset, that same asset, XYZ stock, and you own it in a trust account, an individual account, just an after-tax brokerage account, the capital gains tax apply. So, quick example. I'm into examples today, apparently. I'm not doing a great job at them, so forgive me. This is a live show, so in a way.
You're doing a great job, Brad.
Thanks, man. Thanks. So, this is on the fly example here. If I buy XYZ stock for $10 and that stock goes to $12, my basis is 10, my gains are $2. With me?
Well, yeah, I'm curious when that gain on a stock, if I buy that in, September of 1 year, when do you calculate, because those stocks are going up and down, when do you calculate the loss or the gain for the tax reasons?
Great question. So, capital gains applies after 12 months of ownership. That's key. So if you own, in your example, I think you said September. If you buy something in September, XYZ stock, let's say you bought it September 1st, okay? And you sold it September 2nd the following year. If you sold it for a gain, you pay capital gains tax on whatever the gains were, okay? If in that same example, you bought that stock September 1st and you sold it in August, so only 11 months later, same asset, you would actually pay ordinary income tax on that, not capital gains. You can see where they're incentivizing the holding period, right? And I, by the way, I tend to believe in this because as a financial advisor, I believe in time in versus timing the market, right? I believe in time is the kind of your best friend here when it comes to building wealth and investing for the future. We're not into buying stocks one day and selling them the next day because of X, Y, and Z reason.
Which is really important, I think, because I have friends that are, the day trading and they're on the Robinhoods and they're buying, selling.
Yeah.
That you really have to keep in mind, like if you're doing it on the really short term and you're making a little profit, you're going to be taxed on that. If I do it in an hour, it jumps up.
Yeah, exactly.
I'm taxed on what I make.
Well, you're taxed in both camps, but you're taxed at ordinary income in that regard versus capital gains. And depending on the income for that person in that year, it can be quite different.
Yeah.
One thing I want to talk about too, dividends in companies you might own. Dividends are taxed at long-term capital gains rates if they're long in that regard. Qualified dividends. Non-qualified dividends are taxed at ordinary income tax rates. So understanding your dividends when it comes to an asset you own is important. Qualified dividends, capital gains. Non-qualified dividends, ordinary income.
Okay, let me stop there. Question.
Yep.
So let's just say I have XYZ stock. I've held it for 5 years. I'm getting dividends per year.
Yes.
Now the stock is going up, so I'm making money over that 5 years, but I'm not paying that stock until I sell that for that capital gains.
Great
right?
point. So there's something in our world called realized and unrealized. Okay. That's a fancy word for sold or not sold. Okay.
Yeah.
If I buy that stock, to your point, for $10 and I hold it for 5 years, I'm not, as long as I didn't sell the position, I'm not paying taxes on what's called unrealized. I may have unrealized gains in it, but I'm not paying taxes on it. Now, if that stock, to my point, was paying dividends, understanding if it's qualified or non-qualified, you might have some tax implications there. Usually minor, but they're important. There's an old saying in our business, right? It's never a loss if it's not sold.
Right.
Right? Because, for those of you out there who kind of, we talked about this about cryptocurrency before, and,
Yeah.
if you bought something for $10 in my example, when it goes down, if it's $8, yeah, it's a loss. But if it's never sold, it's just unrealized losses on paper. Same with gains. It's unrealized. It hasn't been realized. It hasn't been sold yet.
And I know you're not a fan of these, but if you're in crypto, same thing, like Bitcoin's big thing right now. If I've had that Bitcoin for 4 or 5 years, I've made a good substantial bit of money.
Yeah.
When I sell that, is that the same as a stock with capital gains versus
Right
income?
now it is.
Right now it is.
As it currently states, it's treated as an asset, a taxable asset. Again, I know I've said this multiple times today, not a CPA. I can talk dangerously to taxes, but I won't file our 1040. Largely because as a financial advisor, it's probably one of the most topics we talk about with our clients. So anything else that you think I didn't touch on today on taxes?
No. I think you hit everything I was curious about.
Okay. Yeah, I think when we see, look, I'll end on this. It's a dumb statement, but I say it a lot to my clients. It's like, they call it gross pay versus net pay because it's kind of disgusting what you would have made prior to taxes.
And the point of our show is you want to hold on to as much of that money
it's
as
not
you.
what you make, it's what you keep.
Yeah.
And when it comes to assets like we talked about, which is really what I was focusing on today, it's not what you own, it's how you own it. The actual asset you own defaults to the account ownership rules when it comes to taxation, which is why we wanted to talk about all of that. I hope you guys enjoyed that show today. As always, make sure to like and subscribe, share this with your friends, bookmark this because we are in tax season. And so until next week, I think next week we're talking about MLB contracts. A little bit of switching gears. We kind of like to throw some fun in here, but
Oh, spring training is coming
spring training's
up.
coming up. We're baseball nuts here. So spring training's coming up. We're going to talk about the Juan Soto deal. We gotta. And it's really important for you guys to know, just because we're talking about sports and money, here's what I want to bring up. There's a lot of planning tools that you can learn and yearn from these guys.
Yearn and learn?
Learn and yearn?
Wow, what does that mean?
Learn
Lean
and,
into? Learn? Dude,
I
cut that out.
don't know where you're going with that.
I don't know. We can learn from a lot of these things and how these, what we would consider, oh my gosh, he made $750 million. Yeah, well, there's a lot of advisors like myself, we do this for our athletes, behind the scenes, agents, tax accountants, things like that, to structure this in the most efficient way. So a lot you can learn from that. So stay tuned to next week and always remember to lead with love. Everything's gonna be okay. See you soon.